The problem from this video can be downloaded at accountingworkbook.com. If you go to the website, click the PDF link and you can download a copy of this and all of my problems for yourself. Now, if you check the website and you click on videos, you'll see there are more videos than those I've listed publicly on YouTube. You can see that there's every problem covered in the workbook has either a public video or a members only video. If you'd like access to the members only video, just click the join button beneath the video player on YouTube. All right, let's jump into the problem. Let's examine problem 9.4a. We've just been doing a couple of bonds issued at discounts. Now we're going to look at accounting for bonds issued at premiums. If you've understood the discount side, the premium side isn't much of a stretch. But if you haven't understood the discount side very well, this is your second crack at bonds, and maybe the premium side will help bring things into focus. On April 30th, 2024, Smoky Inc. issues a $10 million 10-year 7% bond. So we're giving 7% annual interest, 3.5% semi-annually. That's our interest that we're giving to our bond purchases. The people loaning us money, we're going to pay them back 7%. The market rate of interest is 6%. So okay, similar companies to us are offering 6% in the market. Our risk profile kind of warrants 6%. We're offering 7%. People are going to really love our bond, and they're going to want to pay, and in fact overpay for our bond. They're going to pay more than face value for our bond. Our bond is going to issue at a premium. Because the market rate is lower than the bond rate, the bonds issue at a premium. The bond quote is 107.439. Remember what that number is? That is the quote, but it's also a percentage. 107.439%. That's how much we're going to charge. 107% of what we were asking. So we wanted 10 million. Well, guess what? We're getting 10.7 million. We're getting over $700,000 extra dollars because we're paying more in interest over time. Now we've got enough information to do our first journal entry, April 30th, 2024. Now, I'm just dawning on me as I work on this. If you're just coming to this and going, I want to start on 9.4a, make sure you've watched the video for 9.3a. I really will spend a lot more time there explaining each step. This kind of assumes a little bit of background knowledge. It assumes you've tried 9.3a already. So if you're just jumping into this, don't start here. Start with 9.3a and then move over to 9.4a. But anyway, let's continue. So on April 30th, what happens? Well, again, what is a bond? We're borrowing money. We're giving a bunch of pieces of paper out saying, I owe you this much, I owe you that much, and there's to hundreds of potential lenders all at once. We're getting cash, though. And how much money are we getting? We're getting more than we asked for. We asked for 10 million. We're getting 10.7. 10,743,900. Now, what am I giving up? Well, I'm giving up pieces of paper saying I promise to pay you back. Bonds payable, 10 million. And what's the difference here? It's the premium. Now it's a missing credit of 743,900. They paid 743,900 above asking for these bonds. They paid a premium. Now, what does a premium do? Well, we're paying high interest through the bond. We're paying 7% when the market rate was 6%. The premium reduces that interest cost because it's almost like interest revenue. You can think of that as an extra 74, like extra cash of 743,000 that I don't have to pay back at the end of the bond. That's almost like an interest premium, right? It's extra interest. It's good interest for me, not interest expense. But having said that, to get that extra interest, it means I've got to pay it out over the life of the bond. Okay. So we've done record the journal entry for the issuance of the bond. Now we got to do this table. Prepare a bond amortization schedule for the issuance in the first few, actually it's only the first 2 interest periods. So let's do the issuance of our bond on April 30th, 2024. Now on the issue date, I don't have an interest payment. I don't have an interest expense. I don't have a discount or a premium to amortize. I do have a premium account balance of 743,900, and I do have a bond carrying amount. Now, If I had a discount, it would be blank minus D. Because I have a premium, it's 10 million plus D. So 10 million plus whatever's in D. D is 743,900. So it's 10,743,900. I should have dealt with these headings as well, A, B, C. Let's take a look. Interest payment, blank percent of maturity value. Well, this is what we're promising to pay, and our rate is 7%. Now, again, because everything's semi-annual here, we got to divide that by 2. We get 3.5%. It's 7% per year, 3.5% every 6 months. And this table is a semi-annual table. It's an every 6-month table. So that's why we have that number. The market rate is what's relevant for our interest expense. Our market rate was 6%. Again, divide by 2. That gives us 3% is the percentage we're going to use for this column. Discount amortization, well, we don't have a discount. We have a premium. Discount account balance, nope. Premium account balance. And we've done the bond carrying amount. Okay, so that's April 30th, 2024. Our first interest payment happens 6 months later on October 31st. So again, May, June, July, August, September, October. Yep, that's 6 months. What's happening on October 31st, 2024? We make an interest payment. We pay 3.5% of our maturity value. So 0.035 times the maturity value, which was $10 million. We pay $350,000 in interest on this day. The interest expense is 3% of the carrying amount. 3%, 10, 743,900 is our carrying amount. Just column E there. We pay the interest expense is 3% of that. So times 0.03, 322,317. Now this time, premium amortization is A minus B. You might have remembered discount amortization was B minus A. Premium is the opposite, A minus B. So 350 minus 322. 350,000 minus 322,317 is 27,683. Premium account balance, D minus C. 743,900 minus 27,683 is 716,217. And our bond carrying amount, 10 million plus whatever's in column D. So 10,716,217. Okay, so that's October 31st. The next interest payment is April 30th, 6 months later. So November, December, January, February, March, April. So yeah, that's right. April 30th, 2025, we make a payment. Now, again, the interest payment is 3.5% of maturity value. Our maturity value is still 10 million bucks, so it's still 350, and unless there's some sort of bond redemption or something going on here, we expect this to be the same every 6 months. That's the idea of bonds. It's like steady Eddie. They call them fixed income. For the investor, they're fixed income. For the borrower, for the company, they're like a fixed expense. It's the same every 6 months, or a fixed cash outlay, I guess I should say. Okay, the interest expense here, 3% of the preceding bond carrying amount, 0.03 times the preceding bond carrying amount, which was 217. 3% of that, 32148, we're going to round here, 321,487. Our premium amortization, A minus B, so 350 minus 321,487, 28,513. Premium account balance, D minus C, 716,217 minus 28,513, 687,758. And last, 10 million plus whatever's in column D, 10,687,758. Okay, there we have it. My pen's on the fritz again, so I hope it's reasonably legible. Okay, so we've done the bond amortization schedule. Now we got to do journal entries. We did the issuance of the bond. On to the first interest payment. For the first interest payment, it's just this line. This 6-month period is covered by our first interest payment between April 30th, the issuance, and October 31st. Let's see what's happening. We make a payment of $350, so credit cash, of course, $350. Credit cash $350. The debit to interest expense is $322,317. $322,317. The premium amortization, we reduce our premium. Our premium, when we set it up, was a credit. To reduce it, it takes, of course, a debit. Debit premium $27,683. And there we have it, October 31st, 2024. Our next relevant date is not April 30th, as the item indicates. It's our company's fiscal year end, which is December 31st. So what do we have? October, so November, December, 2 months, right, between October 31st and our fiscal year end. Well, let's think about this. This line, noted by April 30th, represents the time period between October 31st and April 30th. It represents, let's see, October 31st. So November, let me just minimize this, December, January, February, March, and April to get us up to April 30th. Now we're interested, our fiscal year end happens here. We're interested in December 31st, so we're interested in these 2 months out of a total of 6. We're interested in 2/6 of whatever's going on here. So for instance, we're interested in this interest expense, but because it's only 2 months, we're interested in 2/6 of that interest expense. 321,487 times 2 divided by 6. 107,162 is our interest expense for our fiscal year on December 31st. That amount again was 107,162. Our premium amortization, which takes a debit, is 28,513 again times 2/6. 9504. Now our credit would normally be to cash, but we're not paying any cash today. We pay cash every 6 months. The people that have invested in us, the people that have bought our bonds, aren't expecting a cash payment today, and they're not going to get one. But the amount, 350 times 2/6, is very relevant. It's the amount of interest that is built up. 1166667. I can see I've got a rounding problem here. 1166667 I've rounded, and you can see 2 plus 4. It's not going to equal exactly, but it's no big deal. If I had rounded or not rounded at all, this would have worked out perfectly. I'm going to leave this as is. If you're off by $1 in my class, no big deal. Your prof might want you to go to the decimals, but that's their prerogative. So normally here we would credit cash. We're going to credit interest payable, and I just want to show my debits don't quite equal my credits. 107,162 is my debit, plus 9504 debit gives me 1166666. I have 1166667, and it's just a rounding thing going on. Okay, so that was December 31st, 2024. That's going to bring us to our final entry, April 30th, 2025. What happens on April 30th, 2025? Well, we make our payment, right? We make a payment, so I credit cash. How much do I pay? I pay the full amount. I don't pay 4/6 or some smaller amount. I pay $350 on April 30th, so credit cash $350. Any interest payable needs to go away, so I'm going to debit interest payable. 116667. I also need to get rid of, or not get rid of, record the interest. Now, how much interest expense has built up? Well, we dealt with the 2/6 up to December 31st. Now we're dealing with the period between December and April. How many months is that? January, February, March, April. That's the other 4/6. That's the other 4 months. That's these 4 months, January, February, March, April. So hopefully to the surprise of no one, that's 4/6. So I just, for my interest expense, it's going to be 4/6 of that number. And for my premium amortization, 4/6 of that one. So let's do it. 321,487 times 4 divided by 6. 214,325. 214,325. That's my interest expense. 214,325. And my premium amortization, and that is 28513 times 4 divided by 6, 19009. Now, hopefully this adds up. Let's just see. 214, again, I think I'm off by $1. 325 plus 19009 plus 116,667, 350,001, and again it doesn't match because it's off by $1 because of rounding issues. No big deal for me. If I had made this a 6 and this one a 6, it would have worked out perfectly, but again, it's just because pennies, which when we're doing this with our computers, they're not going to round in the same way. Okay, we've done it. We have solved problem 94A. If you found this video useful, and I hope you have, you're here at the end, I do hope you'll consider hitting the old like button. All right, thanks a lot, everybody. Have a great day, and I'll talk to you soon. Bye for now.